In September 2008, a financial institution that had survived 158 years of American history vanished in a single weekend, Lehman Brothers. Its collapse meant $600 billion in assets evaporated, retirement accounts turned to dust, and millions of jobs disappeared. The fuse for this economic explosion was lit years earlier by a simple, appealing lie. Why rent when you can own? In 2002, after the dot-com bubble burst and 9/11, the Federal Reserve, led by Alan Greenspan, slashed interest rates to just 1% to stimulate the economy. Money became extraordinarily cheap, and borrowing transformed into a national pastime, with credit flowing freely. The housing market, a pillar of American wealth, suddenly became the hottest investment game in town. Banks aggressively pushed mortgages, even offering ninja loans. No income, no job, no assets required. Traditional requirements like 20% down payments and verified income evaporated, replaced by the promise of homeownership. This wasn't just about shelter, it was about the American dream, weaponized by the message, why rent when you can own? Enter the subprime mortgage, loans for people who realistically shouldn't qualify, often with bad credit or no income. The pitch was always the same. Don't worry about repayment. Housing prices always increase. It's the safest investment. By 2005, the housing market became a nationwide casino, with home prices rocketing upward at rates that defied economic logic. Ordinary people with ordinary incomes were treating real estate like day trading, fueled by minimal savings and zero money down loans. Beneath this facade, banks accumulated enormous piles of risky subprime mortgages. Wall Street then bundled these questionable mortgages into complex financial instruments called mortgage-backed securities, selling them as safe investments. Credit rating agencies, paid by the very banks whose products they rated, stamped these bundles with AAA ratings. They even took the riskiest parts and recombined them into collateralized debt obligations, or CDOs, which also received high ratings. Skeptical investors, betting against the housing market, bought credit default swaps, essentially insurance policies that paid out when mortgage investments failed. By late 2006, reality intruded. Adjustable rate mortgage payments doubled, leading to missed payments and foreclosures. Housing prices, which were supposed to only increase, started falling, and those subprime mortgages began detonating. Banks realized their balance sheets were filled with worthless assets. The AAA ratings were fiction. Panic spread. Bear Stearns collapsed in March 2008, and Fannie Mae and Freddie Mac teetered on the brink. Then, on September 15, 2008, Lehman Brothers, a 158-year-old titan, filed for bankruptcy. The government decided against a rescue, sending a global message. If Lehman could die, anyone could. Credit markets froze completely, banks stopped lending, and businesses faced sudden bankruptcy. The stock market went into freefall, jobs disappeared, and foreclosures multiplied. The crisis didn't respect borders, impacting Iceland's banking system and European banks. The US government faced a nightmarish decision: let the system collapse or bail out the reckless institutions. In October 2008, Treasury Secretary Paulson and Fed Chairman Bernanke asked Congress for $700 billion to prevent total economic collapse. Congress passed TARP, the Troubled Asset Relief Program, authorizing $700 billion to bail out the financial system. Banks received capital injections, AIG received over $180 billion, and even auto manufacturers like GM and Chrysler were bailed out. The Federal Reserve deployed unprecedented measures. Interest rates dropped to zero, and quantitative easing injected trillions into the system. By March 2009, markets hit bottom and began a slow, painful recovery, but Main Street was still drowning. Unemployment peaked at 10%. Nearly 8 million jobs disappeared, and 4 million homes were lost to foreclosure. Meanwhile, many executives whose decisions caused the crisis received golden parachutes and bonuses. Public fury boiled over, leading to the Occupy Wall Street movement in Zuccotti Park in September 2011. The movement's slogan, "We are the 99%, captured the feeling of a system rigged against ordinary people. Perhaps most galling, virtually no senior Wall Street executives faced criminal prosecution for the fraud that destroyed millions of lives. The system survived, but public trust in institutions did not. The 2008 financial crisis was a man-made catastrophe, born from greed, enabled by deregulation, and amplified by complexity. Remember that the next time someone tells you, "This time is different," it never is.